The IRS could be taxing up to 85% of your Social Security benefits, and a single mistake with your retirement accounts could cost you a 25% penalty on your entire account balance. If that doesn't get your attention, it should, because today we're talking about the silent wealth destroyer that most people completely ignore until it's too late. Taxes in retirement. I'm your host, Van Richards, and welcome to the Retirement Learning Lab, where we help you to navigate the journey to a secure and fulfilling retirement. Today, we're continuing our series on getting your financial house in order, and we're diving deep into something that can make or break your retirement security. Understanding tax-sensitive accounts and the considerations that could save you tens of thousands of dollars or cost you just as much. But before we dive in, I want to mention that everything that we discuss is purely educational. I'll share some insights about retirement planning and tax strategies, but nothing that you hear today constitutes investment, tax, legal, or financial advice. Be sure to stay tuned until the end of today's podcast for more information on the limitations of this information. Now, let's talk about why understanding your tax-sensitive accounts isn't just important, it's absolutely critical to your retirement success. Let me start with a story, as I sometimes do, that'll illustrate exactly what I'm talking about. I had a client. He was a successful engineer, and I'm going to call him Robert. He came to me, and he was so proud of his retirement savings. He had accumulated $800,000 in his 401k over 30 years of diligent savings. And he said, Van, I've put everything away that I could, and I think that I should be all set. But when we sat down to calculate his actual retirement income, Robert got the shock of his life. That $800,000 really wasn't $800,000 at all, since every dollar was in a traditional 401k, every dollar would be taxed as ordinary income when he withdrew it. In his expected retirement tax bracket of 22%, his $800,000 was really only worth about $624,000 in spending power. Now, that was a considerable amount, but here's where it gets worse. Robert was also expecting about $35,000 a year in Social Security. However, because his 401k withdrawals would count as income, up to 85% of his Social Security benefits were going to be taxed too. So not only was his 401k worth less than he really thought it was, but his Social Security wasn't going to be what he thought it was going to be too, because it was going to be reduced by taxes. Robert looked at me and he said, Van, I feel like that I've been saving for 30 years just to give it to the IRS. Is there anything that I can do about this? Well, I told Robert this. I said, yes. But it requires some understanding about some things that a lot of people really don't think about. And I'll talk to you about this too in the audience. That is the different types of tax treatment your accounts can have and how to strategically use them. So what do I mean when I talk about tax-sensitive accounts? Simply put, a tax-sensitive account is an account that allows taxes to be delayed, be tax-free, or creates a current or future tax burden. If you think about it for a moment, tax-sensitive accounts actually covers just about every asset that you own. That's because every asset has the potential to be taxed by the federal, state, or local government in some particular way. And tax laws change too. But here's what's most important that a lot of people don't realize. The timing, I'll say that again, the timing and the type of taxation can make an enormous difference in your retirement. Having the right mix of tax deferred, tax exempt, and taxable accounts will help you to minimize your taxes when you begin withdrawals. It also helps you to determine how much income tax that you'll actually end up paying on that precious Social Security that will help you in retirement. Let me give you some examples of what I'm talking about. If you have a tax deferred account, like let's say a traditional 401k, and you take a distribution too early before the age of 59 and a half, you could be hit with a 10% tax penalty on top of the regular income taxes. Now, if you take that distribution too late, that is after the required beginning date, which is generally 73, you could be hit with a whopping 25% penalty on that amount. And you also have to pay the income taxes that go along with it too. Now, I guess you could look at it this way. It used to be 50%, but 25% is still a pretty big penalty. Plus, depending on your income and the type of income you have, your Social Security could be taxed as well. It's like the perfect storm of taxation that can devastate your retirement income if you're not prepared. Now, to understand how to optimize your retirement tax situation, you need to understand three basic types of tax treatments of your accounts. Now, that's tax treatments. First, you have tax deferred accounts, and these are going to be the 401ks, the 403bs, the traditional IRAs, and the tax deferred annuity accounts that you might have. Now, second, you have tax-free accounts, sort of. These are going to include Roth IRAs, Roth 401ks, health savings accounts when they're used for medical expenses, and municipal bonds. With these accounts, you don't get a tax deduction when you contribute to them, but the money grows tax-free and you don't pay taxes when you withdraw it in retirement, assuming that you follow the rules. Now, I want to give a little bit of a caveat there before I go into this too far, because I mentioned HSAs or health savings accounts. Now, that's a real important account to consider that a lot of people overlook because it's actually got a triple tax benefit. It's a non-taxable contribution when it goes in. There's no taxes on any of the accumulation. And if you take it out in the proper way, you follow the rules, as I just said, it's tax-free. So keep that in mind too. And then the third type of account is going to be your regular taxable accounts. These are going to include your regular savings accounts, your CDs, your brokerage accounts, and your investment accounts. With these accounts, you really don't get a tax deduction when you save the money. You pay taxes on the interest and the dividends each year, and you pay capital gains taxes on the profits when you sell them. Now, that's unless they are inherited by one of your future heirs, but that's a topic for another day. Here's why this matters so much. Each retirement account that you have, it serves a different purpose. And having the right mix, you could save thousands of dollars in taxes. One of the most powerful strategies for managing taxes in retirement is something called asset location, not asset allocation, but asset location. This is different from asset allocation. Asset location is about placing the right types of investments in the right types of accounts to minimize your overall tax burden. Here's the basic strategy. From a tax standpoint, tax-deferred accounts are better suited for investments that pay income, dividends, regular capital gains. Taxable accounts, on the other hand, are better suited for investments that rely more on growth in their value. Let me give you a concrete example. Let's say that you're considering investing in two different types of stocks. One that pays a high dividend that focuses on growth. The other one will focus on growth, that is. Now, the dividend paying stock would be better suited for a tax deferred account because those dividends, you're going to pay taxes on them every year if they're in a taxable account. Now, the growth stock, on the other hand, would be better suited for a taxable account because you'd only pay capital gains taxes when you sell that. And those are rates that are generally much lower. Now, this is a little different, though, if you have mutual funds, because mutual funds can have realized capital gains on an annual basis. But that's something that you should talk to your investment advisor about. It can help you to gather more money or to defer more money. Now, let me give you a brief story. I had a client who had implemented this strategy and saved over $3,000 a year in taxes just by moving her dividend-paying stocks into her IRA and keeping her growth stocks in her taxable account. Over 20 years, that's $60,000 in tax savings just by being smarter about where you're saving, not finding a better investment, but finding a better place to invest. Now, let's talk about something that catches many retirees completely off guard. That is how your retirement account withdrawals can cause your Social Security to be taxed. Here's how this works. The IRS uses something called provisional income to determine how much of your Social Security benefits are going to be taxable. Provisional income includes half of your Social Security benefits plus all of your other income, including distributions from traditional 401ks and IRAs. Now, if your provisional income is between $25,000 and $34,000 for a single person, or $32,000 to $44,000 for a married couple, up to half of your Social Security, or 50%, can be taxed. Now, if your provisional income is above that $34,000 for a single person or above that $44,000 for a couple, up to 85% of your Social Security can be taxed. Here's the cruel irony. The more you saved in traditional retirement accounts, the more likely you are to have your Social Security benefits taxed. It's like being penalized for being a good saver. But here's what many people don't know. Certain types of income don't count toward that calculation. Like a Roth IRA, when you take the withdrawals, they don't count. A reverse mortgage, the proceeds don't count. Life insurance borrowing, taking money out of life insurance policies as a loan, which some people do for retirement, don't count. HSA withdrawals for medical expenses don't count. This is why having tax-free accounts can be so valuable to you when you're in retirement. Now, this brings us to one of the most important and most powerful tax strategies available to pre-retirees and early retirees. That is a Roth conversion. You've probably heard about this before. Now, a Roth conversion allows you to move money from a traditional IRA or 401k into a Roth IRA. You pay taxes on that converted amount right now. But then in the future, when you have growth, hopefully, of that money, the withdrawals are going to be tax-free. The key to a successful Roth conversion is timing and the tax bracket management. If you're in a lower tax bracket now than you expect to be in retirement, conversions make a lot of sense. If you're between retirement and age 73, when your required distributions begin, you might have some low income years that are perfect for conversions. Let me tell you about a client that I had named Susan. She had 5 years before she would claim Social Security and 8 years before she had required distributions from her 401k. During those years, her income was actually relatively low. So we did a systematic Roth conversion. We converted about $40,000 a year from her traditional IRA to a Roth IRA. By the time Susan reached 70, she had converted $320,000 to tax-free status. When she began taking the required distributions at 73, her taxable income was much lower, which kept her in a lower tax bracket. And it reduced the taxation of her Social Security benefits. Over her lifetime, that strategy was going to save her about $180,000. But that's a story that's still playing out today. Now, speaking of required distributions, let's talk about one of the most misunderstood aspects of retirement accounts. That is the required minimum distributions. You may have heard them called RMDs. They used to start earlier, but nowadays they're starting at age 73. The IRS requires you to withdraw a certain amount from your traditional retirement accounts each year, whether you need the money or not. Now, this age, as I mentioned, recently increased from 72 thanks to the Secure Act that was passed by Congress. And it will increase again to 75 for people that are born in 1960 or later. Here's some other good news from the Secure Act. Starting in 2024, if you have a Roth 401k or a Roth 403b, if I can spit that out, you're no longer required to take distributions during your lifetime. That's awesome news. This brings workplace Roth accounts in line with regular Roth IRAs, which they've never really required that lifetime distribution. And it's a more level playing field. The amount you're required to withdraw is based on your account balance and your life expectancy. That's how they actually calculate how much money's got to come out. And it can change on a regular basis depending on a couple of different things. The percentage starts small, about 3.8% at age 73, but it increases each year. You see, by age 85, you're required to withdraw about 6.8% of your account balance each year because the IRS wants to get the money before you leave. Here's what makes this challenging. These required withdrawals are taxed as ordinary income. And remember I told you, you feel like that you're always working to pay off the IRS? They count toward calculations for Social Security taxation. Now, I know that there is a $4,000 tax deduction that Congress is still mulling over. Hopefully that'll pass, but it's not making Social Security completely tax-free. You see, for many retirees, required minimum distributions, or RMDs, actually push them into higher tax brackets and cause more of their Social Security to be taxed. But here's the penalty that really gets some people's attention. If you don't take that full required distribution, the penalty is 25%. I mentioned that in the very beginning. And it can be reduced to 10% if you catch your mistake within 2 years. If you were supposed to take $10,000 and you only took $6,000, for example, the penalty could be $1,000 on top of the taxes that you already owe on that distribution, or just $400 if you realize your mistake and you take care of it quickly. So that law I talked to you about, Secure Point 2, it reduced the penalty from the previous 50% rate that was in 2023. I had a couple of clients that got hit by that, and it was really painful. And there was no negotiating with the IRS usually about it. It was just a penalty that had to be paid. I had a client who actually forgot to take his RMD one year. The penalty was $3,500. Under today's rules, it hurts, but it doesn't hurt quite as much. That mistake would only cost about $1,750, and it could go down to $700 if they actually corrected it within 2 years. Still expensive, but much more forgiving than it was in years past. Let me tell you about one of the best kept secrets in retirement tax planning, and I've mentioned this just a little bit a little bit ago. That is the health savings accounts. If you're eligible for an HSA, it's like having a supercharged retirement account. Here's why HSAs are so powerful for retirement planning. You get a tax deduction when you contribute. The money grows tax-free, and the withdrawals are tax-free when you use them for qualified medical expenses. Now, after age 65, you're supposed to be able to withdraw the money for any purpose. It's just taxed as traditional income, kind of like a regular IRA, but if it's used for medical expenses, it's taxed free. But here's the kicker. Healthcare is one of the biggest expenses in retirement. Fidelity did a study, and they estimated that a 65-year-old couple retiring today will need about $300,000 to cover healthcare costs in retirement. Now, that's above and beyond what actually Medicare would pay. Having a tax-free source to pay these expenses is incredibly valuable. I always tell my clients, maximize your HSA contributions before you maximize anything else. It's the only account that gives you a triple tax-free benefit. Now, I'll mention something to you that I've read about recently. It's a part that's in the new tax law that Congress is mulling over. Now, some of you that are retired that are on Medicare, you had to stop contributing into an HSA if you were still working because you couldn't keep both of them going. But there is a new tax change or tax law change that may be possible in the tax law that Congress is mulling that may bring that back. So if you are on Medicare, you may be able to in the future, and you're working and you have an HSA, you may be able to continue to do that. I had that happen to myself and I had to stop. But it only makes sense because you're saving money just the same as everybody else. Why should you be penalized because you're over 65? While we often focus on federal taxes, don't forget about state taxes. Now, I'm in Texas, and Texas has no state income tax. But some states don't tax retirement income at all, while others tax everything. There's even some locales like certain cities that tax retirement income. Some states don't tax Social Security, while others do tax Social Security. Now, if you're considering relocating for retirement, the state tax treatment of your retirement income should be a part of your research and your decision. Moving from a high tax state to a no tax state could save you thousands of dollars every single year. Now, there's one more aspect of tax sensitive accounts that many people overlook. That is the impact on your beneficiaries. Different types of accounts are treated very differently when you pass away. Traditional retirement accounts pass to a beneficiary with all of the tax burden intact. Your beneficiaries will have to pay income taxes on every single dollar that they withdraw. Under current law, most non-spouse beneficiaries have to withdraw the entire account over 10 years, which can push them into a higher tax bracket. Now, Roth IRAs, on the other hand, pass to beneficiaries tax-free. You keep getting the idea that Roth IRAs are a significant benefit. I had a client that's younger that recently had the opportunity when they just started work to put money into a Roth 401k and a traditional 401k. I told them, split it up because you could use the tax deduction today, but believe me, 30 years from now, that tax-free benefit is going to make a big difference. Now, in the example that I just mentioned to you, that example, they still have to withdraw the money, that is, the people that had inherited it, within the 10 years in most cases, but they won't owe any income taxes on the withdrawals. Here's what I want you to do this week to get your tax-sensitive accounts organized and optimized. First, Make a complete list of all of your accounts and categorize them from their tax treatment, that is. List all of your tax deferred accounts, like your 401ks and your traditional IRAs. List all of your tax-free accounts, like your Roth IRAs and your HSAs. List your taxable accounts, like your savings accounts and your investment accounts. Now, here's the second step. Review each investment in each type of account. Are you holding the income-producing investments in the taxable accounts where they're generating an annual tax bill? Are you holding the growth investments in tax-deferred accounts? Here's what I want you to do this week. To get your tax-sensitive accounts organized and optimized, first make a complete list of all of your accounts and categorize them by tax treatment. List all of your tax-deferred accounts like 401ks and traditional IRAs. List all of your tax-free accounts like your Roth IRAs and your HSAs, and list your taxable accounts like your savings accounts and your investment accounts. Second, review the investments in each type of account. Ask yourself this question. Are you holding income-producing investments in your taxable accounts where they're generating an annual tax bill? Are you holding growth investments in your tax-deferred accounts where they're not getting the benefit of capital gains treatment? Consider whether that your asset location really makes sense. And then here's the third step. Calculate your current tax diversification. What percentage of your retirement savings is in tax-deferred accounts versus the tax-free accounts versus the taxable accounts? If most of your money is in tax-deferred accounts, you might want to consider a strategy to create a more tax-diversified investment strategy. And then fourth, review your beneficiary designations on all of your retirement accounts. Here's why. This is real important. The beneficiaries on retirement accounts supersede your will. If you have something in your will that designates different diversification or how the money is to be passed, that's one thing. But your retirement accounts allow you to name certain beneficiaries independent of your will. Make sure they're current, that is your retirement accounts and the beneficiaries, and they go with your wishes. Remember, retirement accounts pass by beneficiary designation, not your will. And then fifth, if you're between retirement and 73, calculate whether a Roth conversion might make sense for your situation. Look at your current tax bracket and consider whether you have a low income situation that might be perfect for a conversion. You see, by taking these steps, you accomplish several crucial things for your retirement security. First off, you gain clarity about the true after-tax value of your retirement. Remember Robert, the person I talked to you about in the very beginning? Had he have done this long time ago, he'd have been in a much better situation when he got into retirement. Now, we moved some stuff around and helped him out, but he would have been in a much better situation had he started out earlier. Many people are shocked to learn how much of their retirement accounts will go to taxes. Next, identify opportunities to minimize your lifetime tax burden through better asset allocation by locating it in different areas. Remember, we call that not asset allocation, but asset location. And then next, look at the potential of Roth conversions. See, you create a strategy for managing your required distributions and how your Social Security is going to be taxed. And then Fourth, in this list of we're going through here, you ensure that your accounts are set up to transfer efficiently to your beneficiaries. Most importantly, you move from being a victim of the tax code to being strategic about minimizing your tax burden in retirement. Take advantage of tax laws. Don't be penalized by them. Now, next week, we're going to complete our series on getting your financial house in order by taking a look at estate planning and considering some final documentation. We'll discuss the documents that you need to have in place now, how to organize everything from your spouse or your family, and how to create a comprehensive financial roadmap that ties everything together. We'll also talk about the ongoing maintenance that's required to keep your financial house in order and how to make sure that your plan stays current as tax laws change or as your situation evolves. So that's all for today's episode of the Retirement Learning Lab. If you found this valuable, please subscribe wherever you get your podcast and leave us a review. If this information can help others who might need it, pass it on to them. Remember, taxes can be one of the biggest expenses in retirement, but they don't have to be. With proper planning and understanding of your tax-sensitive accounts, you can keep more of your hard-earned money working for you instead of going to the IRS. Don't wait to address your tax planning situation. Now, these strategies that we've discussed today are very valuable and they're important for you to implement. And the earlier that you do, the better it will help you. Remember though, this is not advice, this is just education. Also, here's a freebie for you that'll really help you out. Download the Retirement Life Workbook at forms.richardsfinancialplanning.com and use the tax planning worksheets to organize your accounts and identify opportunities. Now, next week, we'll wrap up everything by getting your financial house in order with estate planning and final documentation. Until then, take control of your tax situation. Remember this, the path from insecure to in control includes making sure you're not paying more in taxes than you have to. I'm Van Richards. Thank you for listening and joining me on the Retirement Learning Lab.